Minimizing downside risk while maximizing upside potential is a powerful concept, and charting gives you this ability. That's what we do here every day is we study how we can minimize downside risk and maximize upside potential. The charts, by looking back historically at what has happened in the past, by using our indicators like the price percent oscillator and the derivative oscillator, particularly the price percent oscillator when we see weekly vertical crossovers, and of course after pullbacks, and then the 2-day chart moving in the same direction as the weekly chart, and then a trigger on our 4-hour chart, it works time and time and time again. Is it perfect? No. Anyone who would tell you that is a liar, and they're trying to con you, but it is right so many times. And it's the reason we practice every day. We need you to spend 10 to 15 minutes with us every day. That's all. We don't ask for any more. If you spend more, you're probably wasting your time. If you're watching the news thinking you're going to get tips and hints at what to do, on Wall Street, they joke. You buy on the rumor, you sell on the news. The deal's already done. The charts show you reality. They allow you to separate the signal from the noise. So let's get away from the noise. Let's get into the signal. Let's see what happened over the course of today. We start looking at these charts. We see stocks are down for the day. First pullback in a little while. We see that bonds and gold are up. Let's jump first into the S&P 500 as we always do on SPY. By the way, Patreon members, just sent an email out to you. It includes a brand new training looking over a whole bunch of charts as we move through this quarter and start looking at where things are going, not only here but around the world. Please, Patreon members, pay attention to, check your email boxes, watch that special training. You want to be a Patreon member and receive that kind of stuff, you can find a link in the show notes and sign up. Let's keep moving along. We see that again, this so far, even with a little bit of a pullback on Wednesday, is an up week, down 0.23% on the S&P 500. We have a green candle that's forming with a higher peak than the prior week. Derivative oscillators gaining a little momentum. Price percent oscillators heading up. We go from the weekly to the 2-day. Going to have to pull back a little bit. 2-day is pretty much flat. We do have, of course, this latest 2-day candle, only the first day of it, but it is a nice, and again, Heikin Ashi candlesticks are different than your standard type of candlestick, which is high open, low close. Heikin Ashi is actually put together in a different way, but it allows us to see average pace, and we see that the average pace as far as price movement goes on the candlesticks continuing up, derivative oscillator losing momentum, but we can see we've got things pricing higher as far as the Heikin Ashi calculations. Prices above the 2-day trend line, well above the weekly. Again, the concern we have is the fact that that price percent oscillator is quite flat. We look at the 4-hour chart and we can see that for a day and a half, prices have been sliding sideways and down. The 4-hour charts crossed over. We gave you a warning on that. We said yesterday, if you saw that and wanted to jump in, be very careful in the morning. Of course, morning was a warning candle. Was it a jumping in point for you there? And then, of course, a further pullback in the afternoon. Price percent oscillator heading down, derivative oscillators flat. Again, prices above the 2-day, but getting a little long in the tooth. Let's just see what happens with SPY at this point. Again, our bigger charts flat on the 2-day, still heading up on the weekly. We go from the S&P 500 to the trade that we have been in for quite a while. And of course, we had that weekly vertical crossover going all the way back to January the 25th. And but for 2 weeks of pullbacks, things have just been roaring up. And again, another up candle that's forming. We are down for the day on the Qs, 0.32%. Now we see that the derivative oscillators gaining a little momentum. Price percent oscillators still heading up. So the weekly chart's still strong. The 2-day chart, again, just like the S&P 500, not quite as weak, it doesn't look like, That's so hard to see. It's pretty much flat. Again, the 2-day chart we see as far as the 2-day candle goes, first day of this latest 2-day candle. Again, it's not hitting higher highs actually yet than it did in that previous candle. Price movement is well above the 2-day. It's a nice big candle so far. But again, flat derivative oscillators losing momentum. We go from the 2-day to the 4-hour. And of course, the 4-hour up in the morning, weaker in the afternoon. You know, we've had it flatten out and go sideways on us and sort of digest upward movement. And of course, if you remember, we got into this latest Qs trade. It has been a good one for us. We got in right there in the afternoon on April the 1st, around 181. And again, high top around, we topped out at 190.71. Again, that's pretty nice. We're about a 2.5 week, 2.5 week, almost 3 week period. So quite nice movement, well above the 2-day trend line on the 4-hour chart. Of course, well above the weekly. Some weakness in the afternoon. So again, keep your eye on things. Don't like that 2-day chart getting flat, but it may gain some momentum. Not saying you have to get out yet, but you have a damn good virtual profit at this point. Remember, you can pull your trigger anytime. And of course, you want to watch all the charts all the time. You know, you're going into new territory with higher highs. So again, at some point, what goes up does have to come down. So again, make your calls. You can sell portions of a trade. You don't have to sell everything out at once. Many times I will find certain strike prices, areas that I like where I think there might be resistance to going higher. When I hit those certain points, I'll sell off a portion of what I had purchased, like maybe a third, maybe a half, and then let other things ride. It's a nice when you get to a point where you can play with the market's money and not your own. So that's where we are on the Qs. That play is still in trade for most of us. It is for me. Again, I want you to be practicing these virtual trades as often as you can using the trade worksheet available for free in the show notes. If you're not a subscriber to chartingwealth.com, you'll get our daily reviews every day with the show notes there attached and all the latest information and the latest training. In fact, we put a new training out to you yesterday. If you're not signed up, please go ahead and sign up. We'll send it to you in the show notes. Just go to chartingwealth.com, put in your email address, and you'll be signed up for free. You'll receive our daily reviews and our once-a-week review and any special trainings we put out. Now, let's keep moving through these charts. We're leaving stocks. We're going to bonds, up for the day 0.82%. So what do we have so far with our new week that has been forming? We had 2 prior weeks of down movement. This week now is a green spinning top, means indecision tending up. We were in a crossover territory with the price percent oscillator. It's pulled back. As I said, you can't call a candle until it's fully drawn. Weekly candles aren't drawn until Friday afternoon. 15-minute candles aren't drawn until 15 minutes runs. So again, we've seen this go from what looked like going to be a red down candle with a crossover going down to now it's a green spinning top. That's subject to change. Derivative oscillator losing momentum. Price percent oscillator still heading down, but still positive. We go from the weekly to the 2-day. First day of this latest 2-day candle, green up candle forming, derivative oscillator losing downward momentum. Price percent oscillator is about flat, heading up a little bit. Price is above the 2-day trend line, and of course the weekly still in a confirmed up move. We go to the 4-hour chart. What do we see there? 2 big up candles showing that 0.82% gain where things just bounced and slammed up. But again, we don't have a trade here. Why? The 2-day and the weekly are conflicting. Got to have them both moving in the same direction before we can look for a trigger on the 4-hour chart. You want to know more about what I'm talking about? You can take all the trainings for free at the website. You can also buy our book. You'll see a link in the show notes, Charting Your Way to Wealth. If you live in the States, you can follow that link and buy it right now. If you live overseas, all I need you to do is email me. That's cw@chartingwealth.com. We'll send you an invoice via PayPal. We'll get your book to you anywhere in the world where mail is delivered. Okay, lastly, we go to gold. Gold is up 0.29% for the day. Again, We have a red down candle forming in gold. Gold had gotten rather nice and low over the course of the prior day, down to 119.55 for the week. That's the low. It closed the day at 120.47, so again, up 0.29%. We see the price percent oscillator gaining downward momentum, derivative oscillator gaining downward momentum, both things heading down, red down candle, no wick on top, wick on the bottom. That again is portending some decent down moves. Of course, we had that weekly vertical crossover back on the 29th of March. Has been good to us so far for a down move in gold. We go to the 2-day chart. What do we see? We see on that 2-day chart, first day of the latest 2-day candle, a green spinning top means indecision tending up. Derivative oscillators lost some momentum. Price percent oscillator still heading down, but is weakening somewhat. But again, things are still pushing down. Is gold going to bounce somewhere again around 120 and head back up? Don't know. Pressure is to keep it down. We shall see. We go to the 4-hour chart. That's where we see things bouncing off this 120 mark, something like that, and heading up. How long will it go up? That's some decently strong push off the bottom. We'll just see. Again, you can pull your trade at any time if you were in a down play on gold with virtual puts or in one of the inverse gold funds, or you can continue to watch things run. You still have the power of the weekly vertical crossover working for you, and that 2-day chart's not too weak at this point, so keep your eye on things. Folks, that's where we are as we end the day. 10 minutes, 15 minutes a day is all we ask. Stay with us day after day after day. This is something you need to do on a daily basis. Like I've been saying, if you've not been following us on a daily basis, commit yourself to do that. If you had been, fell off the wagon, get back on it. It's not too much time. I try to keep this as exciting as I can, and I'm telling you, it's the most valuable 10 to 15 minutes a day you will spend for your future. At some point, my friends, these markets are going to roll over. And when they roll over, it's going to be bloody, it's going to be nasty, but we're going to see it coming, just like we've seen in the past, just like we've seen with the quarterly and the weekly charts. When the hammer drops, we're going to be sitting there ready for it. And we are not going to be getting screwed. We are going to watch things happening. We're going to be smart about what's going on. I need you to train with us every day. Read all that you can. Do all the work that you can. Pay attention to what's going on around you. Think about this stuff. Take notes. Listen to all the special trainings we have available for you for free at chartingwealth.com. Go over those. Take notes. Fill out your daily market worksheets when you have the time to do so. Your weekly market worksheets every single week. And of course, do trades. Do those practice trades. Do them on the practice trade worksheets. Those are all available again on the show notes. They're PDFs. You can print them out. We also have a spiral bound book, a 3-month. Each book is 3 months of those worksheets, both the daily market, weekly market, and trade worksheets arranged in a weekly order with the trade worksheets at the back. And it allows you to keep all those things together so that you have a really, really great trader's almanac. Again, it's all up to you. It's your life. It's your time. Spend it how you see fit. But I'm telling you, you won't regret the time you spend on this. You cannot cram for this. This is not college. This is real life. And you need to be with us every day, practicing this, getting good at it. Because when you look at what is coming our way, and you know how to read these charts and how to get into inverse funds, and watch them skyrocket as everything else is on fire and dropping, at least you don't have to write it down. And if you're smart, you can write it up in inverse funds, gold, bonds, whatever might be working. Then, of course, when everything crashes and starts to rebuild, there you have your nest egg. In fact, I hope it's 5, 10, 20 times what it was before. You can jump back in where prices are cheap and ride it back up. That's what our long-term mindset is all about. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters.